All right, let's talk about taxes. For most people, it's this thing you do once a year, right? You file it, you forget it, you move on. But what if that's the wrong way to look at it? What if instead of just filing taxes, you could actually design a system for them? In this explainer, we're going to flip the script, moving from that reactive mindset to a proactive one, and learn how to truly architect a financial structure that works with the tax code. Okay, let's jump right in, because this one idea is huge. It's the fundamental difference in how money flows. You see, as an employee, the sequence is set in stone. You earn a buck, the government immediately takes its slice, and then you get to spend whatever's left. But when you're a business owner, the order flips completely. You earn a buck, you spend money on all the things you need to run the business, and then, only then, do you pay taxes on what's left over. That simple switch and sequence, that's the entire playing field. So, how do we actually use that advantage? Well, here's the game plan. We're going to build this thing pillar by pillar. First, we have to understand the two different tax realities that exist. Then we'll get into the nuts and bolts of your business entity and splitting up your income. From there, we'll dive into what I call the real estate paper engine. And then the real magic, unlocking those losses to work for you. Finally, we'll see how it all clicks together to create a powerful financial structure. Okay, first things first. Before we get into any tactics, we have to understand the philosophy behind the rules. You gotta realize the tax code isn't just a random set of rules designed to take your money. It's a guide, and it's actively trying to push us to do certain things. This right here is the big mindset shift. The government wants people to take risks, to start businesses, to create jobs for others, and to provide housing. And to make that happen, they bake huge incentives right into the tax code. So the goal isn't really to avoid taxes, it's to align what you're doing financially with the exact things the government is trying to encourage. So that brings us to our first pillar, your business entity. I want you to think of this as the foundation of your entire financial house. Seriously, the legal structure you choose for your business, it's not just a piece of paper. It is one of the most powerful levers you have for tax efficiency. Now, if you're a sole proprietor or you have a standard LLC, this number, this is a killer. It's the self-employment tax. That's the full freight for Social Security and Medicare, and it hits every single dollar of profit you make. As your business starts to do well, this tax just becomes a massive drag on your ability to build wealth. So, what's the move? For a lot of profitable businesses, the answer is the S Corporation. This is your first major architectural decision. Why? Because an S Corp lets you fundamentally change the character of the money you earn. And here's the core mechanism. It's actually pretty brilliant. With an S Corp, you split your profit into two different buckets. The first bucket is a reasonable salary that you pay yourself. That salary, yes, it's subject to those payroll taxes. But, and this is the key, any profit your business makes above that salary can be taken as a distribution, and distributions are not subject to that 15.3% self-employment tax. Okay, let's run the numbers so you can really see this. Imagine your business makes $140,000 in profit. If you're a regular LLC, you're paying 15.3% on that whole amount. That's over $21,000 gone. Now, as an S Corp, maybe you pay yourself a reasonable salary of $60,000. You pay payroll tax on that. But the other $80,000, that comes to you as a distribution. Boom, you just saved over $12,000 in taxes in 1 year, just from changing your entity. So when should you start thinking about this? Well, the rule of thumb for most tax pros is this. Once your business is consistently clearing about $50,000 a year in profit, that's the time. That's usually the point where the tax savings are big enough to easily outweigh the extra costs of running the S Corp. That's your magic number. Okay, pillar one is locked in. Our business is running tax efficiently. Now for pillar two. We're shifting gears from our business operations to strategic assets, specifically real estate, which, as we know, the government loves to incentivize. The secret weapon in real estate is a concept called depreciation. Basically, the government says, hey, your building is getting older, so we'll let you take a deduction for that wear and tear. For residential rental, they let you deduct the value of the building over 27 and a half years. And get this, you get to take this deduction even while your property is likely going up in value. Wild, right? And that brings us to this incredible, kind of mind-bending idea of a paper loss. Because depreciation isn't a real cash expense, you're not writing a check for it, you could be collecting rent and have positive cash flow every month, but on your tax return, it actually looks like you lost money. This is, without a doubt, one of the most powerful wealth-building tools the tax code offers. Now, what if you want to put that paper loss engine on steroids? That's where a cost segregation study comes in. It's basically a deep dive analysis of your property that separates out all the components. Things like carpets, appliances, cabinetry. They can be depreciated way faster, over 5 or 7 years, instead of that long 27.5. What this does is pull a massive amount of future deductions into the present day, giving you a giant paper loss right up front. Okay, this is where it all comes together. We've got our efficient S Corp, we've used real estate to create this massive paper loss engine. But there's a problem. There's a big wall between the two. How do we get those real estate losses to actually help lower the tax bill from our main business or our job? This right here, this is the final boss battle of tax strategy for so many people. See, by default, any loss you have from a rental property is considered passive. And the rule is, passive losses can only be used to cancel out passive income, like profits from your other rentals. They can't touch your active income, the money from your W-2 job or your S Corp salary. So how do we break down that wall? Well, it turns out the tax code itself gives us a secret key. It's called the short-term rental exception. There are 2 conditions. First, the average stay for your guests has to be 7 days or less. And second, you have to materially participate in the business, meaning you're hands-on, not just a passive investor. If you meet those 2 tests, the IRS doesn't see it as a passive rental anymore. It becomes an active business. And that is the final connection. That's the holy grail. When you combine a short-term rental strategy with a cost segregation study, you generate a massive, active paper loss. And because it's active, you can now use that loss to directly attack your active income from your job or your business, potentially wiping your tax bill all the way down to 0. So let's just zoom out for a second and look at what we've actually built here. This isn't about finding some weird one-off loophole. It's about designing an interconnected system where every piece makes the other pieces stronger. When you boil it all down, we've really just used 3 core mechanisms. First, we used our entity choice, the S Corp, to split our income and cut down on payroll taxes. Second, we used real estate and depreciation to create huge paper losses. And third, the master stroke. We changed the character of those losses from passive to active so they could wipe out our main income. And this just brings us right back to that core philosophy from the beginning. The tax system isn't just about collecting money, it's a giant map of incentives. By creating jobs with your business and providing housing with your real estate, you are literally aligning your financial activities with what the system wants you to do. So I'll leave you with this final thought. Moving forward, the real question isn't just how much tax do I owe, it's about the very design of your financial life. Are you just going to show up once a year and comply with the rules? Or are you going to become the architect and build a structure designed for long-term efficiency and growth? The choice really is yours.